Well, I just struck gold in San Francisco. Peter Hug joins me now. Peter, nice to be with you at the Metals and Minerals Conference.
It's nice to be here, Daniela.
But let's talk about today's bounce in gold. Peter, did that catch you by surprise?
Yeah, it actually did. I mean, I've been bearish this market. I'd suggested the market was heavy for the past couple of weeks and thought that 1255 would probably not hold, and if it didn't, it would get into the 1220s, which it did this morning. And my commentary this morning suggested that I probably wouldn't step in here and buy, and an hour later it popped up $20 and silver bounced about 30 cents. I don't know why it bounced. I didn't see any news on it. I'm suspecting it's the Thanksgiving week. It's a thin market, and some of the shorts took their profits and went home early. We'll see if it gets through 1255. If it does, I might need to reassess, but as long as gold's under 1255, I'm still seeing this market as heavy in tone.
So what's next, Peter, besides your anger that stores will be open for Thanksgiving?
Well, again, I think this market will, if we can get over 1255, I think we might get a little bit of a surge coming into year end. There tends to be a Christmas rally in metals. So I'm looking to see if that is possible. And we also have the issues coming up at year end with the budget debt ceiling talks again. So there is some news coming up that could be a price supportive for the metals. But if you look at the overall market in the short term, looking at it today, the fundamentals and the technicals still look terrible to me.
Right. Well, that's a different tune I'm hearing from you, Peter. So let me ask you, we're at the San Francisco Metals and Minerals Show. What's the sentiment like?
Well, from the presenters, as is to be expected, 80% of the presenters here represent gold mines, and obviously they're trying to be as bullish as possible. The hard money asset people are still constructive on the market. They're still bullish. One of the commentators today brought up an interesting point. You could look at this conference almost as a contrarian indicator. In 2008 through 2010, when the metals were at their peak and rallying strongly, there were 3,000 attendees at this conference. Now there's probably under 500. And so there seems to be less interest from the investor group. I think they've been hammered on this market, and I think it's going to take some work to get them back into this market.
Let me ask you, Peter, from an investor perspective, if I were to give you $10,000 right now, how would you divide that? What would you be looking at? Besides going to the casino.
Again, the first question I always ask when somebody asks me that question is, if they're not standing in front of me, is how old are you, and what's your risk tolerance? I've invested my whole life sort of with the rule of thumb that I learned way back in the 70s when I took my securities accreditation in Ontario. When you're 20 years old, you should have 80% of your assets in more high-risk type of investments, such as stocks, some junior stocks, where you can afford to take the risk because you have your earnings years in front of you. Maybe 20%, in more safe assets when you're that age. But as you get older, when you get into your 60s, you've got to totally reverse that ratio. So if you're 70 years old, or you would have maybe 30%, 20% in equities where there is a risk factor. Because if you're wrong, you don't have any earning years left ahead of you to make up that mistake. And then you tend to be more conservative with the balance, you're 70%.
Is there anything you would absolutely avoid right now, Peter?
Long-term bonds. Although I don't think tapering, as I've been saying as a broken record for the past 14 months, is an event that will occur until 2014. I do think the trend somewhere in 2014 will be for firmer interest rates, and if you're in a bond past a maturity of 5 years, I think you're going to get slammed.
Finally, Peter, what's the best investment advice you've ever received?
Don't average down. If you've got a bad investment at $700, it's not a better investment at $600.
On that note, Peter, I'll let you get to your panel. Thanks so much for doing this special edition of For Pete's Sake on location here in San Francisco.
You're welcome. Thank you.
And happy Thanksgiving, Peter.
Thank you. Same to you.
And thanks for watching our coverage from the Metals and Minerals Conference here in San Fran. You can email me at newsfeedback@kitco.com or follow me on Twitter at Daniela Cambone. Thanks for watching.